Okay. Okay, I'd like to wish you all a Happy New Year. Welcome you to the first seminar of this semester. And I'm delighted to introduce our speaker today, Dr. George Gloukoviezoff.
Yeah,
sorry.
Oh, that's fine.
I practiced. George is currently a visiting postdoctoral fellow here at the Geary Institute, and his main interest is in financial inclusion. Today, George will be talking about creating credit and not debt. So, George.
Thank you. So, as you can guess from my name, I'm French. I promise there's no blasphemy in my presentation. I also apologize, there's no statistics, so no regression, nothing. It will be just qualitative mainly. Maybe to explain you what it is about, the study I will present is a study I carried out during the postdoc. It has been funded by the Central Bank of Ireland and the Social Finance Foundation. And I was asked to look at the possibility to set up a personal microcredit scheme in Ireland. So microcredit is just a buzzword. Basically, it's just about affordable small loans. But when you say microcredit, suddenly it's fancy and you have kind of exotism with the idea of India and all those countries. But no, it's just small loans for poor people. The whole thing is part of a 3-year project, which is with a university in France, in Bordeaux. So we are finishing this year, which was looking at the relevance of those small loans for low-income borrowers. So we have assessed the impact in France of over 2,000 borrowers. So I will give you a few words about it. What I will do actually is cover the whole thing because I didn't know what would interest you the most or bored you the least. So you have the whole thing, so you could interrupt me as much as you want. There will be basically 3 parts. First, I will present the result of the study about what are the needs of low-income households. Then I will present what are the insights from good practices, mainly in Europe, but also a bit in Australia. And then the solution that should be implemented in Ireland, but that just it's just my own view, and that the central bank insists for me to say that it doesn't commit them in any way. It's just my own personal interpretation. So the study, of course, had a literature review of what have been said on that issue. Sorry. There were 17 in-depth interviews with potential borrowers, so it's in-depth qualitative interview. It lasts between an hour and 2 hours. There's only 17 because at the start it was planned to do 25 or 30, but the thing is you have already quite good body of research on financial aid or low-income household in Ireland and in the UK, but mainly in Ireland. And the thing is, after 17 interviews, I didn't come up with really things which would change the world in the understanding of low-income household needs. So I thought it was better to use my time looking at what haven't been done before, which is assessing good practices abroad, rather than to continue to interview people and bother them with no really added value. So I spent more time on the good practices, so there's 9 of them. I will come back to that later. And then once I had an idea of what could be done in Ireland, I interviewed Irish stakeholders, which are mainly, so the central bank, of course, but it's MABs, it's the banks, it's the credit union movements, An Post, St. Vincent de Paul's, and others. But so that's a bit the study as it stands. So the first thing is the need for a personal microloan scheme in Ireland. So that based mainly on the interview of people on low income and on the literature review. So the first question for people who want to set up such a scheme is there a market, as they say? So by the way, the word market means absolutely nothing here because people can't afford the cost of these services, so it's not a market really. But is there a demand, let's say? So the Citizen Information Board, who is committed in that issue for 2 years now, tried to assess it. So they come up with a figure which is of just over 230,000. So I just updated their figures with newer figures. So we are just below 300,000 people who potentially would be the target for such a scheme. But when you compare with what is the issue here, which is the moneylender's customer, you see that there is actually a big proportion of the population who borrow from moneylenders. So for those who don't know, moneylenders are legal lenders, and the rate could be until 200 or 300% per year for a loan. So it's not exactly cheap, but all that is legal and regulated by the central bank. Probably you know of Provident, or if you follow football, you have heard of about Wonga or those kind of things. It's in the UK. And the last thing, in Ireland, you don't have payday lender, in case you're interested. They're just money lenders. So even if we have that figure, I didn't come up with a more precise figure because I think it's absolutely impossible, but it gives you an idea of the population. But what is important to understand is that it's not only an issue for a low-income household, because there's two issues at the same time in terms of access to credit. First, there is a reduced access to consumer credit, following the crazy years of everybody could access credit. There had a bit of a change in policies in banks and also credit unions, so they have more regulation, they're a bit more careful, so it's more difficult to get a loan. And also there is increased financial pressure on household budget, so even people with an income which would qualify them as middle class, let's say, could be potentially the target for such a scheme. So just to give you some figures, to give you an idea, not just about poverty with the three different main indicators. So you could see that for the most recent figure, 2012, you could see that there's still a significant proportion of the population which is concerned by poverty, in different definition. And it goes over a quarter of the population being at risk of being in poverty. If you take as an indicator the deprivation rate, which is the fact not to be able to afford at least two goods on a list of 10 essential goods, if I'm right. So poverty is rising. I think it's still rising. But there is also other issue, like actually the inadequacy of income, which is does your income allow you to face your daily expenses? So I want to say one thing here, that microcredit is not a solution to poverty. It won't substitute to a structural income, a proper income. That's the main issue here. But my work was to work on microcredit, so I can tell you that small loan can help people on low income. But first, it would be more interesting to target the problem of low income. But if you want just some figure, you could see that in 2011, the most recent figure here, you have 17% of the population who go into debt for ordinary living expense. More than half of the population is unable to afford an expected expense. So what they will do is turn to a lender, and for most of them, they will turn to money lenders because nobody else will be able to lend money. And I put that here, you would say, well, that's obvious that you have a big part of the population which can save, but that's an issue if you want to borrow from a credit union, because to borrow from a credit union, I know you all know what are credit union, I guess, in Ireland, yeah, it's quite common. You need to save before to become a member and be able to borrow. So if you are in a situation where you can borrow, well, you can, we can save, you can access. And finally, it's not only people at risk of poverty, as I was saying, which could be, which could have a need of personal microcredit. It's also lower middle class, because you have had a study from people from the RSI recently, which was showing that actually the squeeze middle is not only a buzzword, it exists, but it concentrates on the lower middle class. So even there's inequality in the middle class. So that's consistent with what we find in other countries. Actually, they were targeting that thing for what they call poor people, and actually there are people with a job who are coming saying, I can't face that kind, I can't fix my car, I will lose my job, and then it is a small loan. So you have to understand that financial exclusion, because that's what it is about, it's exclusion from credit, is not only your usual problem of poverty with your usual profile of people in poverty, it's also people who can't access mainstream finance, and that could be an issue for a broader scope of people. So to do something useful, it's better to try to meet the need of the population you try to reach. So the first thing to understand is the way people manage money. So I will just go quickly through what came up through the interviews and literature review. So we know that people on low income manage their money in cash, either because they can't access bank account or financial services, or because they decide not to access those services. So an important point here is they don't manage in cash because they are too stupid to understand they should have access to, they should use financial services. It's because for most of them, these financial services are not appropriate to their need. And it's because they know too well how much it will cost them to use a bank account, a direct debit and all that they prefer to manage in cash. So actually it is rational and clever to manage in cash when you are a low level of income, because you need to have a very, very detailed understanding of your budget, because sorry, I make very long sentences, but we're always saying, and that's some economists would do that, saying like, look, when you have a low income, you're more often into debt, so people don't know how to manage their money. Well, actually, it's just like it's more difficult to manage on a low income. So studies in the UK on financial education show that people are as illiterate when they have, in terms of financial management, when they have very high level of income or a low level of income. Just you can't afford to be not a perfect budget manager with a low income. Another thing also is that budget management technique change with financial inclusion. But which means that when you are using a bank account, debit card, well, you will want to be able to repay your loan with a direct debit or transfer or whatever, and not in cash. That's one thing. But there is things which remains. For example, we know that people who manage in cash have a tendency to use the technique which we call the jam jar, that you put money aside in a jar for specific spending, like for holidays, if you can afford holidays, but more usually for bills, for rent and those kind of things. But people who have access to financial service do the same, and you might do the same, is that you have a saving account for your tax, you have an account for the daily spending. So that's a way to separate different stream of money. So those things have to be understood, because when you will organize the repayment of your loan, you could use this knowledge to make the thing successful. I just look at time because I like to talk too much. Well, yeah. I also look at the borrowing patterns. So that's very obvious, but when your situation deteriorates, well, you don't have access to the mainstream bank, so you will turn to the credit union, and the credit union will say, no, it's not anymore possible, so you will turn to the money lenders, and when the money lenders will say, no, it's not possible, you will turn to the illegal money lenders. So that's people I have met, that's the way it goes. And of course, when it deteriorates, it becomes more and more expensive and more risky. So that's a problem. People use different lenders for different purposes. So if you want to buy a car, people tend to use more a bank, while when they have to face an emergency, they will more use a money lender. But they also use their relative to borrow money, but that's more complicated because that's supposed to expose your difficulties, and there's also judgmental thing which come in. So people tend to prefer something more anonymous, and that's where that's something which have to be learned from money lenders, is that money lender never judge you. They're always very understanding and happy to meet you if you want money. So when you provide personal microcredit, you are not a charity giving a lecture to an imbecile of poor people. You have to understand that you have to respect the need of people, and more to look at the financial situation. And actually the real thing which is important here is the fact that when people are in difficulties, they try to keep a portfolio on lenders. So they will maintain relationship with several money lenders, with a credit union, and if they can, with the banks, because they need to secure access in case of emergency. So even if personal microcredit scheme was successful, people will probably still maintain those relationships, thinking, well, I have a loan from that scheme, but what if I need another loan? Will they give me another loan? So it won't be people switching from one to the other suddenly. So it won't be a failure if they don't move away directly. There is few challenges then to meet those needs when you want to set up such a scheme. First, it's people who will want very small loan, sometimes like 50 euro, 60 euro. They want to understand easily what they will pay, and they want that to be fixed over the whole period. So basically, money lenders are very good. They charge you an awful lot of money, but you know from the start what you will pay exactly, and it doesn't move if you have a problem or whatever. That's the price you will pay. And if you look at services which target people deprived area, that's the kind of price techniques they use. You pay for everything, it's very clear, but it's very expensive, of course. And you also need affordable repayment. That's a problem for banks. That's not their model. They prefer to lend big amount because that increase their profit, because that reduce the proportion which of the cost to set the loan. And they also like to charge when there is a problem to repay. I come back to that. Application process, well, quick and transparent, I go quickly on that. Personal and non-judgmental, that's absolutely essential, and that's extremely difficult because all the time when things are set up to help people in poverty, there's always a kind of moral judgment. It's always people, oh, we do good, so you have to listen to us because we will tell you what is really good for you because you don't really know because you're poor. And that's a very big issue. That's everywhere an issue when microcredit is set up, not to lecture people and to take their real need into consideration, which is the following one. Repayment methods, that's what I was saying, and that's also a problem to set up such a thing, is that you have to be able to accommodate people who will repay in cash, but also people who will be lower middle class and we want to pay from their bank account and not to meet with you. So you have to have an approach which is a bit modern of what is micro. You don't need to go the whole way to go and collect the money at the door of the people, anyway, too expensive to do. But online access is a very good idea, even if it doesn't sound like something for poor people, but I come back to that too. Just to give you some figures for you to realize what it is to the business of a legal money lender, about the fact that people face difficulties. So I will just let you time to read that, because if I read it for you, you will have my annoying French accent. But the idea is just like it is normal to have financial difficulties when you have a low income. They are not bold, they are not stupid, they are not irresponsible, which is basically what is usually associated with poverty. No, it's just that as you have very, very tight budget, each thing which happen, which increase your living cost or which decrease your income, will have an impact on the repayment. So it has to be inbuilt that you will have to deal with mispayment. That's fine, a mispayment. What it's not fine, and when people at the end can't repay the loan. But mispayments are normal. So you need flexibility, and you need, most of all, not to charge people for their difficulty. That will be obvious for you, but if someone is not able to repay for a month, how will you be able to repay more the following month plus the charge? That's just stupid. And in France, I've been working with the saving banks for years, and on their system, what they do is that you miss payment 1 month, well, but you will pay it in following months plus what was the plan the following month. So you have a double payment to make, which makes no sense, because in the first place you have set an amount to repay which is sustainable. So if you double it, it's not sustainable. So that just increases the problem. Yeah.
One challenge with these sorts of loans is differentiating people who can't pay and people who can pay but choose not to. There's an economist at Maynooth that has argued that here in Ireland, because there have been so few repossessions of properties, that mortgage defaults, up to a third of people that are late in their mortgage payments are actually doing it strategically, that they could pay but they don't. So do you have any suggestions on how to deal with that? And are you going to get to that later? Did I jump the gun?
No, I will. I basically said a little thing on that about the personal relationship. The thing is, the difference between those type of loans and loans which will be like mortgage or even consumer credit, it's all a credit scoring thing, that the guy who gives you the loan don't know you, doesn't want to know you, he just want to collect the information. We help the system to assess your level of risk. Here, the difference is that you can't use the system because they would reject you, because apparently you're too risky. That's why also banks don't lend to those people. So the hypothesis, but it's verified, is that with a personal relationship, you will be able to assess the personality of the person, and it's not efficient 100%. Sometimes there's people that should just play the system very well, but you will see with the level of default, which is quite low, that actually you manage to screen those people and find them, to exclude the people who try to make the best of the system, let's say. And very weirdly, actually, the fact to help people create a kind of moral debt. And what was very surprising, which was unexpected in the French study we carried out, is that people were prioritizing repaying this loan over other debt because people helped them when they needed it. They believed in them. That's what they were saying. I just used their word here. So they were paying. Actually, you have the other element of people trying to give back more, but that's obviously an issue. The fact that some people will go through the system and never repay, that happens, but it's tiny. So that was a quick understanding of the need of low-income people. Now I will give you a quick understanding of what have been done abroad. Here is the list of what I have been evaluating. I will go quickly just to give you an idea. It doesn't really matter if you're really fascinated and passionate by that. You could ask me after and I could give you the report when it will be public. Scot Cash is a structure in Scotland, as its name let guess, which is autonomous, provide loan to low-income people. So it would be the equivalent of a little bank, by themselves. They're called Community Development Financial Institution. This one, it's a credit union which set up an online payday lender, thinking, look, we could do a better business than the payday lender and more interesting for our customer. So it's 100% online. It's extremely successful. No interest loan scheme. It's extremely interesting for economists because precisely it goes against all the odds. It's a system where you don't pay interest. Yeah, okay, that's fine. That's in the name. If you repay, you don't pay charges, and if you don't repay if you miss payment, there's no. But if you don't repay, there's no sanction either. So actually, if you get the loan and walk away, nothing happened to you. But the thing is, precisely, they assess them very professionally. It's local small funds which are managed by local or community organization. And they manage to have only 4% default, which is extremely. A default is the percentage of the money you have lent which doesn't come back at the end. So there's only 4%. To give you an idea, a bank for consumer credit, they expect around 1% or less. So of course it's higher, but with absolutely nothing to punish you. So that's interesting. So that's standalone lenders that do it by themselves. They get the money, they lend you the money. Those three one here. They work with a mainstream bank. Microbank work with the Caixa Bank, which is a Spanish cooperative bank. That's my friends from the French saving banks. And in Australia, it's an organization called Good Shepherd Microfinance, who link between National Australian Bank, which is the equivalent of AIB or something like that, with local organization who lend. So basically, those three structures assess the people and lend the money of those three banks. And finally, there was public fund. So nobody in Ireland wants a public fund to lend, don't worry. In the UK, they have a public fund called the Social Fund, which have been suppressed when they've modernized with the social welfare bill or something like that, which was providing small loans. In France, the Social Cohesion Fund, which work with them and other organizations, actually guarantees a loan. It provides 50% guarantee. So if people don't repay the saving banks turn to that fund and say, give me back 50% of my loss. And the growth fund in the UK, which is the most interesting, and that's really where there was things to learn. It was a fund set up for 6 years, which helped credit union and lenders like those bonds to develop, to become more professional, and to provide access to cheap credit and appropriate credit to people who are borrowing from money lenders. Because the big thing, sorry I spoke so fast, you stop me if I really kill you with all those noise. The thing is, money lenders said, look, we are satisfying a need, so don't annoy us, because if we stop our business, you will have those people who will have to turn to illegal money lenders. So the idea is, don't put usury rate that we can break. For example, you say in Ireland where you can't lend with an APR over 60%, for example. So they will be out of business, but they will tell you, if you do that, our customer will turn to illegal money lender. That's partly true. I think it's rubbish because in France or in all the continental Europe, you have those selling and there's no illegal money lender. So don't really understand, but anyway. So the thing is, to go along with that element is to come up with more appropriate provision of credit. That was the role of the growth fund. It was extremely successful until politically it was decided that actually it wasn't a priority anymore. So what do we learn from that? So from those six lenders and 3 public funds, we learned that the default rate, so what I explained earlier on, was going between 1 and 6%, with an average, of course, of 3%. 1% was, for example, a micro bank, but they treated their customer like bank would do. And 6% actually are the saving banks in France, but it's because it's totally unprofessional the way they work that. They work it at a charity and communication tool, so there's big problem here. But you could say that people were refused by banks because they're supposed to be far too risky. And for 2 of the organizations, they have a default rate of 1%, which is extremely low. So technically, it's feasible. That's important. Second, there is a real impact for borrowers. So we have assessed it in France. In Australia, they carried out the assessment plus the social return on investment to see how the community benefit from it. It helps people to escape poverty. It helps people just, small thing, but just to enter a short-term difficulty, so it won't change the life of all the borrower, but it's a useful tool. So that's to say, that's a good idea to try to set up such a scheme. Now, what is important as features is that it's better to have as little criteria as possible. When you start to say, oh, you have to earn less than that and to be in a couple for 6 years and not to have moved your house for 3 months, you think that's ridiculous. That's real elements which were in some of the scheme. You need to welcome people who are excluded from credit. There's only 2 things which matter. Are they able to repay the loan, basically, when you assess them? And are they excluded from other source of appropriate credit? Could they access a bank loan? Could they access a credit union loan? If the answer is no, and if they're able to repay that loan, give them that loan. It doesn't matter for what it is. For example, there was issue with credit union who were saying we don't fund communion, so that's where I won't do blasphemy. So fine. But if you come back saying, actually I want the money to repaint my kitchen, they give you the loan. They don't check anyway, so you just use that money to fund your communion, which is far too expensive, but that's not blasphemy. So that's important, because if you start to create those criteria, you create difficulty and you create lies, including debts. Some people will borrow money to repay debts. It's not necessarily bad if it's well managed. If you exclude that, it will be funded, but people will lie. And even actually, the people who will grant the loan sometime will lie. In France, it's the case. Social worker or NGO volunteers, they just rename the reason for the loan while it is to repay a bank overdraft or something like that. So yeah, there's no one-size-fits-all approach. It needs to be basically personalized. That's very obvious, but it needs to be said. Another thing is to mix online access and personal relationship. As I said, the first thing people do when they need a loan is to go Google loan. So I know your Tonishta is very surprised that poor people have very fancy device like those mobile phones which allow to go on the internet. But they have them, and then they know how to use them, so they will Google. And if you go on Google and you Google Provident, you will see they have a very fancy website, very customer friendly. So you need that for your personal microloan scheme. You're not doing something that you run from the back of your kitchen. No, it's something which is customer friendly, which is modern, and which treat people, those borrowers, with respect. That's very important. Other point is to set up partnership. For example, I spoke about debt. People will come saying, "Oh, I owe money to Board Gash, to UPC, whatever. Could you give me a loan to repay all that?" You could give the loan for the whole debt. People repay that debt and then they repay the loan. You could also go to MABS. MABS will assess your situation, look if the reason for those debts is there's a structural problem, but they will also be able to negotiate on your behalf with creditor and gain like a rebate. For example, if you owe 200 euro, maybe it will be 150 that you will repay because the creditor is happy to have his money back immediately and is ready to forget 50 euro. So you repay less, everybody is happy, and that's an LCR way to repay that. So in all the organizations, they work basically with debt advice organization, with charities, with social services, with housing association. And for some of them, they work with mainstream financial institution. So that's a good idea if you think that we need to move people towards the financial institution. There's a big problem is that when you work with them, they're extremely powerful and they tend to say, look, that's the way we do business, so you have to do business this way because that's better for our partnership. And that's a big issue with the three that I told you that we're working, for two out of the three we are working with banks, is that they have to replicate bank practices, and those bank practices are precisely what exclude those customers. So you need to understand that doing banking a complete different way. So what is a way to avoid those problems is to have an independent supervisory body, which would be an organization in charge of managing the scheme. They would select the organization who will grant the loan. They will monitor what they do. They will train them. And overall, they will be in charge of being sure that the service delivered meets the need of the people and that what needs to be learned from what is done on the ground is learned and help to improve the whole scheme. To give you one example, in Australia you have an organization called Good Shepherd Microfinance. They are in charge of all that. It's very professional. They help the NGOs who lend to become proper lender. In France, you have all the administrative things in place, blah, 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 but there's nobody who supervises anything. So the banks do whatever they want, the NGOs do whatever they want in the other way, so it doesn't work. It doesn't work. It could work far better. They manage to get great results with very little coordination. Is it clear, Rich? Yeah, you're still standing there. The big issue is it will cost money, we are broke. So, and I'm quoting here. I'm actually Minister for Finance. So, how do you fund your thing? There's one option, which is to make the customer pay for it. Well, it doesn't work. That's called money lending. If you look at, in fact, it works, but not in the interest of the borrower. If you look at the different organizations I have been assessing, NILS charge nothing. They are totally subsidized. Scott Cash charge up to 160% for a loan, IPA. Still far less than what moneylender would do for a similar loan. But the big issue is it's extremely expensive, and Scott Cash is heavily subsidized at the same time. The problem is they are a small organization, so they are paying for all the fee, for all the cost of the operation by themselves. So they have to find the money they have to make money from those loans plus the subsidies. If you look at growth fund lenders, so it's in the UK, that's those who were supported by the growth fund, who were mainly credit union. You see that they were able to make as much money at its cost with an IPA of 40%. So you see when you work with credit union, we are different organizations, you could reduce the APR you are charging. And if you look at microbanks, so that's the one in Spain working with the Caixa, they make profit charging 13%. Well, in fairness, I have to say that, I wouldn't say that if they were there, but I didn't see any of their representatives. But they're a bit of a lie in the way that they explain that they do microcredit. The truth is that they have 14 employees. They provide 40,000 loans per year, which is 10 times more than most of the other organizations, because what they do is basically using the bank system, their back office, so all the system to manage the loan, but also all the retail branch in all the country. That's the retail branch of Caixa, which is providing the loan. That's the employee who are providing those loans. So basically, they just trade as a bank would do, except that they are just more open than the bank is. And they can be more open because as they are a microfinance institution, they are eligible to subsidies from the European Union as well as guarantee fund. So when they have lost, half of it goes to Europe or to Spain government or those kind of things. But what is interesting is that if you are able to spread the cost of what you're doing on a bigger activity, well, you reduce the cost that you charge to your customers. So the conclusion is that we will use the credit union in Ireland because they are doing business with other customers and they could make money out of it. But to come back to that, how you can reduce those costs, it's to reduce the risk because risk is a cost. So by assessing those 6 lenders, it comes up that if you are very professional and you have practices which are designed to meet the need of this borrower, you will have less default, so you will lose less money. The problem is, with my French accent, even me bored me, it is that that's very costly to have a personalized relationship. So another way to reduce risk is to have a guarantee fund that everywhere, so it needs to be set up. And the last one is to get the repayment deduced directly from social welfare. That's a big issue. That's what was done in the social fund in the UK. It means that before you receive your social welfare, your repayment is taken from it and goes straight to the lender. So the lender is paid all the time, there's no default. Problem is that if you are on the other end of the thing, as long as it has been planned properly and everything goes well, okay, you have less money. But if you have an issue, you need to raise more money to pay for example, to fix your car or to pay a bill, heating bill, which is higher than expected. You can say, oh, I won't repay the loan and I will pay gas or I will pay my rent and not be expelled, because there's no negotiation with that. It's extremely rigid. So it exists in Ireland. It's called the LOC scheme or the household budget scheme. It has been suppressed a few years ago because credit union could apply for it. It is coming back, and I would say a word about that later. But that's something which needs to be considered. Finally, almost, it needs to be subsidized. There is this kind of belief that microcredit is a market. It's a market in India because you are serving millions and millions of people, and most of them are middle class. They can't afford it. There's just no bank. So it's like the start of the cooperative movement in Europe. It's nothing to do with what is happening in Europe today. So it makes sense to subsidize it because it can't survive without it. But it makes sense also because there is an impact, positive impact, on society in general. So I look at the time, because I really have to conclude quickly. So that makes sense for the state to spend money in that system because actually it will save more than it will spend, and that's based on economic studies in France and in Australia. And finally, you have also to take into account the long-term consumption of new customers. It means that if credit unions start to this scheme, some of those borrowers would become members of the credit union, and when they will be members, they will use also other services, and that's a way to make money for the credit union. And the one in the UK, London Mutual Credit Union, actually they were able to cover their costs just by taking into consideration the new customers they get and who were using their other services. So basically so it was very, very dense, but that was matter actually after that. It just logic result from what I've said before. There are just 4 points that need to be repeated. Is that you need to know what you want to do. For example, do you want people to move from moneylenders to that new scheme and then stay in this new scheme, or you want them to move from moneylender to this new scheme and move to financial inclusion? Would you them just to use less moneylenders? And you have several aims possible. If you want to assess what you're doing, you need to clarify that, and at the minute in the Irish debate, which is just the start, at least between central bank, social finance foundation and other, it's not clear. Second one is so obvious that you will think that I'm completely stupid to put it, but thing is, it has to be designed around the need of the borrower. Everybody knows that. Everybody agrees with that. It's never the case, or almost never the case. That's simple, because when people will stakeholders will sit around the table to discuss what they have to do, there won't be any borrowers seated around the table to say we need that. And each organization, even the the one who want to do the best for those borrowers, will come and say, look, we have this problem, we do business that way, so we won't be able to have the online access, or we won't be able to do this because that will entail too many changes in our usual operation process. And then bit by bit it will become something which is not appropriate. For the two other, I don't think it really matters for you, but it has to be a learning process. It will be wrong at the start. You have to learn from it to improve it. And second thing, that poverty is a changing issue. So you have to be able to adapt your scheme to the way the poverty is changing. Very quickly, you should use the credit union movement in Ireland. They are willing to be used because they need to lend. That's where they make their money, and at the minute they are not lending enough. So I have discussed with them. There's two movements in Ireland, and they are both willing to be part of it. You have to use partners like ANPOS, MAB, St. Vincent de Paul, because they are those who are able to reach people who borrow, and they are organizations who can support the credit union if there is difficulties. I don't know too much about what we could do with the banks because they are not willing to help. I meet with them. They thought it was a great idea until I told them they will have to pay for it. And that was a less good idea suddenly. That was because I was French or something like that, Marxist. Financial you need a financial inclusion fund. So basically, provide a guarantee because that's what matters to the credit union, to know that half of their loss will be taken by a public fund. That fund, by the way, is where the money of the banks will go. That's why they are not happy, but they should pay for that. It should also help the stakeholders like credit unions. There was, I think it's Brian Lucy, when there was discussion around that, he said credit unions are not able to do that because they are not professional enough in average. And he's totally right. It's very heterogeneous, the credit union movement. You are very professional credit union and less, let's say. But this scheme is a way to make them more professional, to act better. And that's what happened in the UK with the Growth Fund. One of the impacts of the scheme is that credit unions at the end were more professional to deal with arrears, to assess risk. So it has to be seen like that. And an independent supervisory body. I move because you already have seen that. I have explained what they should do. What would be those microloans? Between 50 and 2,000 euro. That's mainly what is that characteristic in Europe. To give you a figure, in average people borrow 500 euro from a money lender. That's the average loan, so that covers it, no problem. The IPR is that's the maximum that credit union could charge at the minute. That's the double. That would be a way to reduce the amount of subsidies you need to run the system. But credit unions are happy to go in the scheme at that level. So at the minute there's no need to discuss that. As I said, no profile eligibility criteria, that's the best, to be able to repay the loan and to be excluded, and to accept all purposes, including debt, as long as you rely on MABs. In the report, I also suggest to set up consolidation microloans, but I won't develop that here, because debt is a serious issue and it needs to be dealt carefully. There are two more slides and you're relieved. No cause for mispayment, obviously, and not to bring people to court because people are worried to go to credit union because they are worried to be brought to court. So that's just ridiculous. You brought to court people who are dishonest, and it's easy to identify because you can't meet with them and they don't try to find a solution. And so that's the damage is done, but you know where to apply those kind of answers. For repayment, I will just focus on the direct deduction. It could be dealt in a way which doesn't harm the borrower, which is to say, okay, it's taken from your social welfare every week, but if you have an issue, you're entitled to come to your credit union and say, I want that money back because I need it. So you will miss a payment, but the credit union gives you that money back when you need it. And that option has to be limited to 3 times. The interest is that people will come, so you can discuss with them why do you need that money back, what is the issue, so to address the issue at an early stage, and it's not complicated to put in place very early. application process at the end. After that, it's a night picture, so you would be really... the option one is you go to your local credit union, you have your face-to-face evaluation, you have your loan from the credit union, and if needed, they could say you should see with St. Vincent de Paul maps for this or that. Other way to go is to go through ANPOST. So by the way, that is this, the credit union are assessing the possibility to pilot that. ANPOST at the minute is assessing the possibility to pilot that with the credit union. It is the thing with the household budget scheme, which is the scheme which allows to deduce from your welfare benefit. So it needs to be under 1,000 euro, because that scheme, you can deduce more than 25% of your social welfare. So it has to fit in those 25%, so it has to be a small amount, because 25% cover all what you deduce. So it could be that credit, your rent, everything. And the last one is to apply online. It's totally overlooked. I have presented that already. Everybody said, yeah, well, that's complicated. That's the main thing. If you don't have that tool, you will miss the main part of the customer base, if we speak like that, which are people who will look first on internet and go to Provident because it's easy to get the loan from Provident. So that gives you that nice blue thing, and that's finished. I think I've been a bit too long, you know. Oh, good. I've picked too fast then. So thank you.